Well, as we finished up the section on contracting, this is certainly something that many producers are used to thinking about, having a forward contract for cattle, grain, malting barley, sugar beets, those sorts of things. On the other hand, there are some problems with contracting. On the one hand, you often cannot participate in any price increases that may have occurred since you have contracted a commodity. The second thing that can happen is that you may not find someone who is willing to contract with you, either for grain or cattle or any other commodity. And in addition to that, if they are willing, sometimes they may not be willing to forward contract at a price that you think is somewhere near that expected price that we've been talking about in the previous section. Someone may be worried about volatility in the market and they're concerned prices may rise, and so they don't want to give you a forward contract for the amount that you would be satisfied with. So consequently, in those cases, you certainly have other things that can be done to manage price risk. This, of course, only involves those kinds of commodities for which there is a futures market established. There isn't a futures market, for example, for pulse crops. But for other general commodities, futures markets provide a way of trying to manage some price risk. Let me start by saying that I'm often asked by groups to talk about futures and options markets, and I'm usually asked to do this when prices are relatively low, because the misconception is that somehow these markets will help you get a higher price. Yet that's not what these markets do, nor what they're designed to do. These markets are designed to manage price risk. If prices are already very low, the odds of them going lower are probably pretty small. And as a result, that's not a time to be thinking about futures or options markets. The time to be thinking about them is when the markets are providing a price that you are comfortable with and one that you would like to try and acquire in advance of the sale of your commodity. And by the way, the last part of this is just like contracting. There's no reason that one should expect or have to forward contract all of your commodities or use futures and options on all of your commodities. In fact, many people use a combination of forward contracting, cash sales, futures, and options as price risk management strategies. So let's talk about futures markets first, and then we'll take a quick pause at the end of this section and finish up with option markets today. We're going to talk about short hedging futures contracts. That is, I'm going to talk about managing downside price risk for a producer who's planning on selling a commodity. We could just as easily talk about this from the other side of the market. If you're a feedlot operator, you're concerned about higher input prices, like the price of grains, the price of feeder cattle. And as a result of that, we'd be talking about a long hedge in the futures contract. So we'll only focus on short hedging since most people in the room are probably considering price risk management on an output that they want to sell in the future. There's certainly a little bit of similarity between short hedging futures contracts and forward contracting. In both cases, it's a promise to deliver something in the future. Now, in the case of a contract, you probably are actually promising to deliver that particular commodity. In this case, you're not likely to deliver the commodity, but you are promising to do so unless you do something to offset that promise, and you're going to get that opportunity to offset that promise. Very few futures contracts are delivered on because it costs so much to load these products up and move them to a delivery point. There's also some differences with forward contracting in terms of futures markets. For example, one difference is that we are trading standardized contracts. 5,000 bushels of 13.5% wheat. That is the wheat contract. Now, if you're raising soft wheat, if you're raising spring wheat, that's one commodity. Winter wheat's a different exchange, but they're standardized contracts, not 3,237 bushels or 4 acres worth or whatever the case might be. It's a standardized contract. And the reason for the standardization is that makes them interchangeable. Your contract is identical to someone else's. So we can trade those contracts amongst each other, and that's where the price risk management occurs. Now, one thing that does change on these contracts is the value of the contract. The size stays the same for everybody, but certainly the value, or the price per bushel, I'm going to be talking about grains rather than cattle, the price per bushel can go up or down. So the value changes, but not the size. And most importantly, the agreement can be settled, this promise to deliver can be settled without actually delivering the commodity. And we do that by using cash to fulfill the promise rather than actually delivering the commodity to another person. This isn't that much different than when we deal with insurance contracts of any kind. Okay? This is a way of settling the contract without actually having to deliver upon it. A little bit more terminology. If you're going to be involved in futures or options trading, one thing you have to do is have a broker. You have to have a broker and you have to set up an account. I've set one of these accounts up for use in one of my classes. It's a little bit of paperwork, takes a couple of hours to do. You have to wait for approval. It takes about a week. This isn't something you do at the last minute. It's something that you establish. And a margin account is that account you have with your broker in which a margin money is deposited. That is, if you open an account, you're going to have to put some margin money into it. Now, you don't have to deposit the entire amount of the contract that you're, in this case, selling. A 5,000 bushel contract at $6 a bushel is $30,000. We don't have to put all that money in there. We have to put some money in that account. And you say, well, why? Well, the contract, first of all, is not likely to be worth nothing in the future. It may go from $6 to $5 or $6 to $7 or maybe $2 one way or the other, but it won't go to zero. And it's not likely to go to $100 a bushel either. So what we have to have is a mechanism, a set of money that assures that the contract can be settled between a buyer and a seller. You're going to be selling this contract and you're going to buy it back later, but you don't know who you're selling it to, and it doesn't matter. Remember, these are interchangeable contracts. But if someone's going to be on the other side of this market, then you have to have some way of settling the contract. Otherwise, if we didn't have those dollars sitting in that account at your broker, that would be the equivalent to an unsecured loan to somebody, in which case you also wouldn't know who the unsecured loan is with. So markets won't work without dollars in margin accounts that allow for the settlement of this of these transactions. And generally, the amount of money you put in is about 10% of the total value of the contract, roughly. More or less, something like that. But the total value of the contract, the 5,000 bushels times whatever the going rate is at the time, the price of those that contract, about 10% of that total value is at least a place to start for every one of the contracts that you own. So here's an example. For a $5.65 bushel spring wheat contract, you'd have to put in about $2,800 into your margin account if you're going to be involved in this market. If you have 2 contracts, you would double that amount. And 10 contracts mean you would have $28,000 of money put into that margin account. Now, this margin money doesn't make any money for you. You don't get interest on it. The brokerage firm is supposed to leave it there and not touch it. We had a bad example of the opposite of that happening many years ago. Markets can't function when people don't follow the rules. The rules are the money's yours. It stays there. It's not invested by you, by your broker on your behalf. It's non-interest bearing. Now, let's think a little bit about the costs of being involved in a hedge. First of all, the broker you're working with has to pay his heat bill and his light bill and his mortgages and everything else. Brokerage fees are somewhere usually between $60 and $75 per contract. That pays for both a buy and a sell, or a sell and a buy, either way. You can get it for less money, as brokers tell me, if you do it electronically online, maybe $30 a trade. But for those of you who are novices and even those who are not novices, working with a broker often makes an awful lot of sense, and the difference in the buy and sell on the turn isn't that big of a deal. For a 5,000 bushel contract, that's $60 to $75 is about a penny and a half a bushel. So it's not a lot of money, but it's something that one has to be aware of. Also, as I mentioned, when you have margin money deposited into an account, it's not only earning interest for you, it is not only not earning interest for you, but you had other things you could do with that money. You could have kept it in a savings account. You could have it in a CD. You could borrow less on your operating loan if this money was not tied up in a margin account. So we really should think about the costs of not having access to that money. Even if you didn't have to borrow it, there is an opportunity cost on that money. So if we just take a number of $2,800 of margin money, 5% annual interest rate, and let's say I'm going to show you an example where we're going to short hedge between December and all the way till next August. Call that a 9-month period of time. The interest costs on that sort of thing would be about 2.5 cents a bushel. So the total hedging cost then would be roughly 4 cents a bushel. A lot of times people just call it a nickel in their own head, so they have some sense of a round number of what the costs of doing this are going to be. So not a large amount, but also, not inconsequential either. So I'm going to use an example where the hedging costs run you about 4 cents a bushel. So that's one of the things that we need to be thinking about. Now, let's use an example here, a situation. Let's say that you are a spring wheat producer up on the Highwood Bench, and it's early December of this year of 2017. And as you look out in the future, the futures market in September on the Minneapolis Grain Exchange is trading for around $6.15. It's about what it was when I put these numbers together. And your basis over the last several years has averaged about 10 cents less a bushel in September at the delivery point that you typically use. And that's the example I was using earlier for our contracting example and for our wheat outlook example as well. Therefore, your expected cash price next September on grain that you haven't even planted yet, it would be $6.05 a bushel. Now, I don't know what the price is going to be next September. If we did, we wouldn't need to have this discussion. But that's probably your best guess. Now, somebody might forward contract with you at $6.05 a bushel, and I think you'd probably be pretty happy with that given this current situation. My guess is if somebody wanted a forward contract with you and was willing to have that forward contract, you're probably looking at something less than 605. And I'll use an example here in a little while. Why? Because of that risk that someone takes from you when they sign a forward contract with you. Now, you decide to go ahead and try to lock in this price. You can't find someone who will forward contract at 605 or something close to that, and you're concerned about price declines by harvest time of next year. So let's say the following happens. Right now, December, we sell a September spring wheat futures contract. That's 5,000 bushels. Spring wheat is traded in Minneapolis. And this is very similar then to forward contracting or selling spring wheat that you don't currently have. So I'm agreeing to deliver something. I'm going to be able to get out of the agreement down the road, but this isn't all that different than thinking about, at least abstractly, as having a forward contract. Now, your expected price in your delivery point up there in the central part of the state is 605. That's your best guess right now. And let's say we go through the year, you plant spring wheat, it actually rains on the spring wheat, that's a good thing, and you end up harvesting that 5,000 bushels. Now you might harvest more, you might harvest less. We'll talk about that in a little while. But let's say you do get that 5,000 bushels in August during combining. At harvest time, let's take a look at what happens if between December of this year and harvest of next year, the national price declines all the way down to $5 a bushel. What do I mean by the national price? Well, I'm talking about the Minneapolis Grain Exchange price. That's the one that matters. So if the MGEX price dropped, remember when you did this it was 615, and now we're in harvest time, you're on the combine, you're checking your smartphone, and the September futures contract has dropped now to $5 a bushel. If the basis is 10 cents per bushel, if the basis does exactly what it has done on average over the last several years, your local cash price in Great Falls would be $4.90. Now the right way to think about this is the opposite. You take the grain, you take it into the elevator, or you call the elevator and you say, hey, what would you give me for this grain today? And they say $4.90. That means with an MGEX price of $5, your basis is 10 cents. If they say I'll give you $5, your basis is $0. If they say I'll give you $6, your basis is a plus dollar. I don't know what that's going to be. And what it means here is that you do want to sell your grain for as much as you can, whether it's now off the combine, whether it's in your bin and you're going to market it later. The difference, though, in those two prices, the leftover is the basis. It's not something that we manipulate. It's the outcome of millions of transactions that are going on. Well, what happened in this transaction? Well, again, you're not going to deliver this grain. Too far to go, too much money to haul wheat that far. Fortunately, you don't have to. Even though you agreed to do it, there's a way to get around from delivering. Remember, we sold the contract. We can now buy it back. We're allowed to purchase it back at the current market rate. And remember, price declined to $5 a bushel. So we sold it, and now we buy it back, and that eliminates your promise to deliver. Now think about this. You sold the contract for $6.15 a bushel, and we bought it back for $5 a bushel. Okay, this is exactly opposite of my house hunting exercises. I do the opposite. Okay, in this case, you've made money on a decline in price. Sounds a little weird, but if you sold it at $6.15 and you bought it back at $5, you've gained $1.15 a bushel in the futures market. Now your local cash market is lower priced as well. Where's this $1.15? It's in your brokerage account. Every day your broker will send you an email telling you the value of your brokerage account. Over the last 9 months, your account could have gone up, it could have gone down. But in the end, when we buy this back and close out the position, your account has $1.15 a bushel times 5,000 bushels, so a little over $5,000 here. Your account has that much more in it than when you started. If you started with $3,000 margin money, you now have over $8,000 in that account. That's your money. The broker writes you a check for that when you ask for it. So you have some cash coming to you as a result of this transaction. Now remember, this costs you something. I use 4 cents a bushel for all the hedging costs, and you still have grain to sell. Now let's just assume you sell it for $4.90. If you sell it for more than that, fantastic. If you sell it for less than that, that's not good. Okay, I went to college to learn that. But your net price here is $6.01. Oh, why does that go? How'd that happen? Well, let's say whatever you got for your grain in Great Falls, I don't know what you'll get. Let's say it's $4.90. Now to that's a check. You get that from the elevator. You got that $4.90. You also have $1.15 coming from the broker. They'll send that money to you. You call them up, they'll give you your money back. That's how it works. Now remember, you're not going to get it all back because you had to pay the broker, and you're going to get the money back, but the interest on that margin money was a couple cents a bushel anyway. So your net price here, the end of the day, is something like $6.01 a bushel. Now remember, your expected cash price was really $6.05, but this wasn't free to do either, so $6.05 minus the 4 cents is $6.01. Now, what happens though if you didn't combine any grain? That is, hailstorm, drought, some other wind, disease, pestilence, fire, almost anything that can happen, right? Let's say that you didn't harvest 5,000 bushels, or you harvest some number less than that. What happens in this story? Well, first of all, nothing happens in the futures market. Remember, you're buying and selling contracts. It doesn't matter whether you have the grain or not. What does matter, of course, is if you don't have grain to sell, You don't get $4.90 a bushel for it. You get zero. So in this case, production shortfalls really don't influence you much at all from the standpoint of your futures market position. Well, let's switch gears. What else could happen? Well, I don't know if prices are going to go down. I don't know if they're going to go up, but I doubt if they're going to stay exactly the same. Something will change. We know that, okay? Remember, let's go back now, and it's December, and we decide to sell. How can I sell something I don't have? Well, how can you agree to deliver grain you don't have? It's a promise. I'm selling the promise to produce wheat and sell it to somebody. And the spring wheat futures contract, when I did this on December 2nd up on the Highwood bench or wherever you happen to be, was $6.15 a bushel. I sold that. Okay. I put money in a margin account. I told my broker to do this. The broker takes care of it. They tell you every day through an email what your brokerage account is doing. Now, at the time, it's December, your expected cash price is $6.05, just like before. We go through the year. It rains. You actually get to and it doesn't hail, and you actually harvest 5,000 bushels in August. At harvest time, let's say, basically, this is what happened this past year, right? We had pretty low prices going into the summer, and then especially spring wheat, especially high protein spring wheat, just went through the roof for about a month and a half, and it's still pretty high. It actually increased between December and harvest, and let's say that same thing happens next year and it goes all the way up to $9 a bushel. At MGEX wheat futures, spring wheat futures, for September delivery, let's say the futures contract increased to $9 a bushel. Now, you take your grain into the elevator. Maybe you do it now, maybe you do it later. I don't know. I'm just going to assume you do it at harvest. And the elevator gives you money per bushel. They might give you $9.20, they might give you $8. I don't know what it's going to be. Let's assume they give you $8.90. Now, why do I pick that number? Well, historically, at Great Falls, we've been about a dime under Minneapolis Grain Exchange price. So I'm going to use the dime. But in reality, it works the other way around. If the spring wheat futures contract when you sell your grain is $9, and if you sell it for $8.90, that means you had a 10-cent basis. And remember, basis won't always stay the same either, but it's much less variable than the change in prices. What happens in this transaction? Well, we sold this contract in December, and now we're going to offset it. Okay, we don't want to deliver grain, too expensive to do that. We're going to buy it back, and we're going to buy it back for $9 a bushel. Now, this is like most of my house purchase situations. You sell the contract for $6.15. But now I got to buy the same contract back for $9. I don't want to do that. Well, but you don't have any choice, okay? That's why we have money in the margin account. Whether you want to do this or not does not matter. You're either going to load grain up and haul it to Minneapolis or the nearest a delivery point, which you all know what that costs, or you're going to go in and buy it back at $9, and you've lost $2.85 a bushel. Now, your hedging cost for the right to lose this money was almost a nickel. I'm using 4 cents. Let's say you sold that wheat in Great Falls for $8.90 a bushel. What's your net price? Well, it's that same 601 that we started with in the previous scenario. $8.90 minus $2.85. Now, where'd that $2.85 go? What happened? Well, while these prices were going up, you would have been told to put more margin money into your account. It's called a margin call. Why? Well, because you need to have at least the $2.85 in there that will be transferred to somebody who's on the other side of the market, who took that downside risk off of you, and in this case, they're not paying you, you're paying them for doing this because prices didn't go down, they went up. In the end, if you had not hedged, now let's very careful here now. If you had done nothing, you would have got $8.90 a bushel, what the elevator would have given you. Okay? What did you end up with? $6.01. Oh man, I wish I wouldn't have done this. Well, is that any different than forward contracting for $5.80 and then having the price go up to $9 at harvest time? Not really. It's about the same thing. You're just saying, geez, but remember, what you're thinking about here is managing price risk, at least on some of your crop. At least you knew some of it was going to be somewhere near $6. And in my previous example, it all went down to around $5. So $8.90 if you're not hedged. Now, in this case, what happens if you didn't harvest any grain? Well, this one's sort of the killer on you, because not only did you lose the $2.85 a bushel, but you're not selling any grain at $8.90, or you're not selling the whole 5,000 bushels at $8.90. So consequently, you're losing both on that cash side price because you don't have grain to sell, and you've lost on the future side price as well. And this is why many, especially grain producers, might market forward contract, hedge, and you'll see in a little bit options, a third of their contract earlier on in the year, maybe their expected production, maybe a third of their expected production if they see it rains a little bit, maybe a third of it later on. Cow-calf producers tend to either forward contract larger proportions of their cattle or use options or futures on larger proportions because their production is much more known. Yes, you can have devastating fires and lose cattle like we did this past year. Yes, they may not come in quite as heavy as we hope. Yes, you could have a bad spring, a bad calving season, more open cows. But in general, you have a pretty good idea of the amount of calf pounds you're going to have year in and year out. That's much less so for wheat producers, where a single hailstorm, a single windstorm can take a crop down to virtually nothing. So, as the price of this contract went up now, sometime it might have went down for a while, but once it started going above that $6.15, you're going to be required to add margin money. At the price of $9 a bushel, the contract is actually worth $45,000. That's over $14,000 more than when you sold it. So you have to have that much more money in the margin account in order to stay in this market. Now, what would happen if you said, I'm not going to put that money in? Well, the broker's required just to get you out of the contract then, and you have no price risk management from that point forward. Given that you had some margin money to start with, you would have had to write a check to your broker for about $11,000 to keep this margin account active while these prices were moving essentially against you. Yeah, I mean, prices are going up. We typically like that, and of course you should like that. But again, in the futures market, that's a price movement that is against your interests. Probably would have had to put more than that in anyway. So a broker will call and say, hey, we need about 10,000 here, we need 14,000, something like that. You have to be prepared to put those dollars in. So let me talk about hedging concerns, and then we'll take a quick pause. Changes in that basis can reduce or improve your net price. You can go either direction, and that's very difficult to forecast. I'll talk about that in just a second, how we do that. This hedging, a short hedge, manages your national price risk, not your local price risk. That means it's not managing basis risk. It's only managing price risk associated with national price movements at the Minneapolis Grain Exchange. Margin calls require capital. You have to write checks, and you have to be prepared to do that. And you and your banker, if you have to borrow this money, had better be prepared to do that. Lack of production, hailstorms, of course, can be a source of larger losses. Short hedges don't allow you to participate in price increases, much like forward contracts don't. Now, what can we think about in terms of this basis? How can I really already talked about this. It used to be that the Wheat and Barley Committee was able to keep these prices in this format I'm showing you here. This is for hard red winter wheat, but they also had it for hard red spring wheat, and it was estimates of basis for different. Well, first of all, they don't keep those anymore for us, which is a real shame. On the other hand, you probably have better things to do with your time than look at numbers like this all day long. So I did introduce you to our wheatbasis.montana.edu website. So at any point in time, this is for the Golden Triangle region, hard red spring wheat, 14 Pro wheat. When I did this, the futures price was actually at $6.41. that day that I put this slide up onto this slideshow, the basis forecast was minus a penny. So if you look on the fourth line there, it says expected cash price, 640. That's my best guess of what my future price will be next September at that particular region. That estimate is done by a bunch of calculations in the background, and so in thinking about what basis is doing, this is not a bad way to sort of keep track of what's happening in the market from the standpoint of a forecast. So with that, I'm going to pause for just a second, and then we will move on to thinking about price risk management using another tool called options. Well, one of the nice things about managing price risk with options is that some of the concerns that we noted with short hedging in futures markets is overcome somewhat by using options. And I'm going to talk about a put option. A put option is a title of an option that you would use if you were trying to manage downside price risk. I think it's a funny name, put. I don't know why it's called put. It is. So a put option simply means I'm the seller of a commodity and I want to take out some insurance against lower prices in the future. If I do that, then I'm going to buy and own a put option. What sort of concerns does it alleviate with short hedges? Well, a put option gives its owner, you, the right to sell a futures contract. You don't sell a futures contract. Remember, in our last session, we sold a futures contract in December. A put option gives its owner, you, the right to do that, but not the obligation to do it. In the previous example, when prices went up, gosh, you wish you hadn't done that. You really wish you hadn't sold that futures contract in December, much like you really wish you wouldn't have signed the forward contract in December if you signed it for 570 or 580. Well, the cool thing about a put option is that it allows you to have a do-over. Okay? If prices go down by a certain amount, it allows you to go back in time and place that futures hedge. If prices go up, never mind, I didn't ever want to do that, it never happened. So that put option allows you to see if prices decline. If they do, then you can retroactively, you can go back to the future. You can go back to December 2nd, even from the combine, and you can sell that futures contract, because that's when you want to happen, is to have a futures contract when prices go down. You don't want to be short hedged if prices are going to go up. And the put option allows you that flexibility. Now, as you might guess, you're going to pay a premium to do this. You're going to pay someone else to allow you to take that position and give you the right to go back in time. So you pay a premium for this right. By the way, who are you paying the premium to? Well, let's think about the following. When you buy auto insurance, who do you pay the premium to? Well, you pay it to an insurance company. The insurance company writes you a contract that says if something bad happens to your automobile after a certain amount of deductible, we'll pay the rest. Well, that's what's happening here. There are people on the other side of the market who are willing to write you an insurance contract for a certain amount of money to protect you from a downside event. Who are these people? I don't know, college professors, not many actually, doctors, lawyers, brokers, farmers, ranchers, dentists, take your pick. People who are looking for risk. What? Who looks for risk? Well, that's what an insurance company does. In exchange for accepting your risk, you pay them money. Why would I want more risk? Well, I'm not certain you do, but those who have money and don't want to earn more than, let's say, 1% interest in a CD right now, this is a place where they can go and acquire risk, because with higher risk comes the potential for higher returns, but of course also for more variability of those returns. So you're going to pay somebody who's going to write this contract to you. You'll never know who they are. Doesn't matter. Okay. you're going to buy a put option which allows you to go retroactively back in time and place that short hedge that would have happened in December. If prices go up, man, you don't want that sucker. You don't want to place the hedge, and you don't have to. That's why it's called an option. So you're buying insurance for price declines. A little terminology. Strike price. A strike price is the price at which that futures contract will be sold retroactively if the put option is exercised. So if prices go down, the strike price is the price that you will retroactively go back to December and sell that futures contract at that price. Out of the money options are those put options with strike prices below current futures prices. So the more out of the money the put, the further the current put option is below the current futures price. The more out of the money, the less expensive the put becomes, because the further you get away from the current price, the less insurance you're buying. It's like increasing deductibles, okay? So it gets cheaper to buy a higher deductible rather than a lower deductible. The difference between the put option strike price and that current futures price that it's going to occur at, that's essentially a deductible in this process. And there's a menu of strike prices for every underlying futures contract. That is going by 10 cents or 15 cents or whatever the futures. There's a whole menu of those out there. You can buy as little insurance as you want or as much insurance as you want. One of the problems, though, with options is that they very often aren't traded far enough out into the future. That is, while there's a futures contract right now trading for September Minneapolis wheat, the options contracts aren't trading out that far yet. They'll start trading when people start getting interested in writing contracts and people get interested in buying those put options. So this is a problem. Sometimes you have to deal with a July option, a put option, rather than a September. So just a couple of things to keep in mind. And by the way, your broker can handle these sorts of things and roll those options as needed be. All right, situation. Spring wheat producer on the Highwood bench, same producer. December 2nd, same date, 2017. Still concerned that while the September 18 spring wheat futures contract is trading at 6.15, you're concerned about prices going lower. And rather than forward contracting and rather than short hedging, you decide to buy an out-of-the-money put option with a strike price of 5.55. Now this is out of the money because the strike price, 5.55, is lower than 6.15. So essentially, here's what's going to happen. This put option will be valuable to you if Minneapolis Grain Exchange September 18 spring wheat futures prices drop below 5.55. If they only come down a little bit towards 5.55, this option's not valued. Now, that's why if you bought a put option at $6, it's more insurance, but you're going to pay a higher price for it. A 5.55 put option historically might cost you somewhere near 25 cents a bushel. When I looked this up, it was 24 cents a bushel last year at these similar prices. So I want to give you some sense for what you're spending in terms of the insurance premium you're going to write. The broker's going to charge you as well for doing this for you about a penny a bushel, roughly. That's a little high. It's in the ballpark, okay? What's going to happen here? Well, at 25 cents a bushel, 24 cents plus the penny for the broker, at 5,000 bushels, you're going to write a check for $1,250, $1,250 to your brokerage account. You're going to write that check. That's when you buy a put option at that amount, that's the check you write. But here's the key. That's the last check you will write on this transaction. Basis changes aren't going to matter to you in terms of futures markets. Production shortfalls aren't going to matter. There's going to be no margin money added. There is no margin money. You write a check. Just like you write the check for your insurance premium on crop insurance, for your insurance premium on auto insurance, it's gone. You're never going to see it again. Okay? You're also not going to have to increase that amount or spend any more money. So that's one of the things people like about put options. If you're going to call it lose, okay, you know your downside risk here is $1,250, 25 cents a bushel. That's it. You're out of the loss category in the futures market. Well, you've done this. You wrote the check. You physically wrote the check to your broker. I've done this before. Not a lot of fun, but hey, you're buying insurance. August 2018 rolls around. You planted grain, you harvest grain, and the September spring wheat futures contract has declined to $5 a bushel. Quite frankly, it doesn't matter whether you harvest a great crop or a bad crop. It isn't going to matter in terms of this transaction. Clearly it matters for your overall financial health. Don't get me wrong there. What I'm saying is that in this transaction, it doesn't matter if you harvest any grain or not. In fact, I have had put options for my class. We never owned any grain. We never owned any cattle. We never intended to own any grain or cattle. And yet we were able to use these markets, in our case for educational purposes, but the students a couple times have actually made a lot of money, even though they had no interest in any of these commodities in terms of physical ownership. And of course, they only made money because of randomness. They didn't make money because they were smart. Okay, your option is now in the money. Okay, why is that? Well, $5 per bushel was your strike price. I'm sorry, $5 a bushel is the September spring wheat futures contract. Your strike price was $5.55. As soon as that Minneapolis Grain Exchange price started to decline before $5.55, your option became valuable. And anytime after that, well, anytime before that as well, okay, remember, you bought this, you could have sold this back at any time. After exercising this option, remember, you bought it, okay, for 25 cents, $5.55. Now when I sell it, I get 55 cents per bushel in my margin account, in my brokerage account. Why 55 cents? Well, because that's how much we're in the money. $5 per bushel September futures is below my $5.55 strike price. I get the difference, okay? And so my brokerage account, your margin account as well, but in this case, it's simply the account you have with your broker. When I do this transaction, I call the broker up and say, hey, okay, I bought this, sell it now, right now, 55 cents, okay? Or whatever you can get for it, okay? And you also then get to sell your wheat. Now, let's assume in Great Falls you get $4.90 a bushel. Maybe you get $5.20, maybe you get $4.80. I don't know. I'm just using that as my example. What's our net price here? Well, it's whatever you got for your grain when you sold it, or when you do sell it eventually. $4.90 a bushel is the number I'm using. First number here on this formula. Now, I also have made 55 cents in the futures market on my option. Where's that money? It's at my broker. It's in the brokerage account. Can I get it? Yes, of course. Once that money's there, you can tell the broker to write you a check. Guess what? They do. They write you a check. I don't know if electronic funds transfer works. I'm not certain. Maybe there's a broker around that can answer that question for you. But certainly they can write you a check and you get it a few days later. Okay, how much would it be? 55 cents times 5,000 bushels. That's kind of nice to get checks. I like those. Remember though, you spent about 25 cents a bushel on this transaction. 24 cents of your insurance premium that you wrote, that's gone. That went just like your auto insurance. Whether you use it or not, you'll never see it again. And you paid your broker to do these transactions for you. So your net price is $5.20 a bushel. Okay, one last example. Suppose prices increase. Okay, this was the example of prices decline. You like this. Essentially, it allows you to go back in time and place the short hedge at $5.55. Actually, that's what happens in the background. You don't know that, but that's actually occurring. Your broker's taking care of that. Let's go back to our example where spring wheat futures contract increases to $9 a bushel. Kind of like what happened this past year, roughly. Okay? Your option is out of the money. Now, what do I mean by that? Well, the current Minneapolis Grain Exchange price at harvest time, September, is up to $9. That's much higher than your strike price of $5.55. That $5.55 becomes valuable when or if prices at Minneapolis Grain Exchange drop below it. But if prices stay above it or increase, then the option has no value. You sell grain in Great Falls today, tomorrow, next week, next month, whatever it is. At some point you'll sell grain. And if you got $8.90 a bushel, or more, less, whatever it is, what's our net price in this transaction if it were $8.90? Well, it's the $8.90 that the elevator operator writes a check to you for. That's fantastic. But remember, you spent 24 cents a bushel on the option, and you spent a penny for the right to do that to your broker, essentially. And so your net price is only $8.65. Now you might say, wait a minute here. I wish I wouldn't have done that either. Well, look, folks, I wish I'd have put every dime I owned into Microsoft in 1982 or whatever. Okay, yeah, I know that. That wasn't the point. We don't know the future. What this does is it says, look, I spent 25 cents a bushel, okay, in order to have a $5.55 price on the Minneapolis Grain Exchange, plus or minus whatever my basis does. You protected the downside. But remember, when you short hedged and prices did the very same thing, you ended up getting only $6 and a penny, I think, because the short hedge hurts you when prices rise. Certainly helps when prices go down. In the case of this put option, you did not have to put out any more money, and you were able to protect the downside and participate in the upside. If you'd short hedged, as I mentioned, your net price would have been quite a bit below the $8.65 or whatever you end up with. Now, I'd like to sort of leave you here with this particular table. And at first, it looks a little complicated, but let's look at it this way. On the left-hand column, I've got 4 different marketing approaches. One in which you just sell with cash. That is, you don't do any forward contracting. You don't do anything. That's fine. There's nothing wrong with that. And I'm going to assume that when you do that, you had a 10-cent basis at your delivery point. And I'm just going to assume that for every one of these examples. I'm also got the second row there, says forward contracting. If your expected price next September is $6.05, I don't think you're going to find anybody to forward contract with you at $6.05. I picked a number, $5.70. Is that the right number? I've got no idea. Okay, I'm just saying someone forward contracts, they're picking a price, you either take it or you leave it. Maybe it's $5.60, maybe it's $5.90, I don't know. But if it's $5.70, that means you get $5.70 regardless of what national prices do. The next row, short hedging, we just talked about. The final row is a put option at $5.55 strike. What do the other columns represent? Well, look at the middle one. Okay, let's say it's December 2nd. Minneapolis Grain Exchange is selling spring wheat futures contracts at $6.15. That's the current market. Okay, if prices don't change, or at least end up at the same place next September, $6.15, then if you sell on the cash basis, that is no price management, you're going to get $6.05 if the basis is 10 cents. If you forward contract, you're going to get $5.70. That's what you forward contracted at. If you short hedged, I show you an example of $6.01. That's not a certainty because basis can change, but if the basis changes on the short hedge, it changes on the cash contract as well. So relatively speaking, we have similar numbers across the rows then. The put option, if price doesn't move, ends up giving you $5.80 a bushel. Why $5.80? Well, you sell your grain for $6.05, but you spent $0.25 a bushel on the insurance that you bought, even though you might say, well, I didn't use that insurance. Well, look, are you unhappy when you don't use your auto insurance or your fire insurance or your crop insurance, or in my case, my life insurance? I'm not unhappy about not using my life insurance. It's not to be used. It's there for protection. Now, let's look at the price decline column. Okay, $5. I made up the number, of course. You notice in cash market, you end up with $4.90, the lowest out of all of these various outcomes. The highest happens to be the short hedge. Forward contract is still $5.70. The put option is $5.20, which isn't awful above the cash, not as good as a short hedge, not as good as a forward contract. Go to the price increase side, way far right-hand column. Clearly, if you know prices are going to go up, then you shouldn't do anything. You should sell grain off the combine as fast as you can. Forward contract, unaffected by a price increase almost always. Short hedge, again, unaffected by the price increase, which is a bad thing. You're still stuck at $6.01. The put option gives you a relatively high outcome on that upside price swing of 865. Okay, so in the end, another way to think about this might be visually. Here I have a graph, several graphs. Okay, one graph, several lines, I mean. And across the bottom, I have Minneapolis Grain Exchange futures prices, starting at $4, going out to $9.50. And if you look at the blue line, okay, the upward sloping blue line, this just represents 10 cents below on the left side, the net price. At $4 Minneapolis Grain Exchange and a 10-cent basis, I'm selling grain at $3.90. At $9.50, far right-hand side, cash market, I'm selling grain at $9.40 if the basis is a dime. What happens if I forward contract? That's the brown line. What the forward contract says, I picked $5.70. Whatever your contract price is, that's the price you get, and it doesn't matter what happens with national prices. If it goes up, you get $5.70. If it goes down, you get $5.70 if that's what you contracted for. The hedge is sort of like the forward contract in that you're sort of locking in a base price. Now, it won't be exactly 601 because basis will matter here, unlike the contract, the fixed price forward contract. So I've got the hedge sort of in quotes a little bit, but it's pretty similar to the forward contract. On average, you should be above the forward contract, but that doesn't mean it's always going to happen. And then my put option is the green line. And notice that when prices are low, it's putting a flat or a downside stop to how low prices can go. When futures prices are below about 530, I've locked in the bottom. Okay? But as future prices go up, I get to participate in those higher price increase with the put option because it doesn't lock me out of that higher price like a short hedge or a forward contract would. So, in summary, let me just say marketing these sorts of agricultural commodities requires a lot of different considerations. The first thing you should know is what is my break-even price. Record keeping is critical. Understanding, especially your variable costs of production, is so important in terms of pulling the trigger on making forward marketing decisions of any kind. Certainly, one should evaluate both cash market speculation on the future versus contracting versus hedging versus options. All of these are tools. No one thing fits all. No one thing fits every commodity, and no one thing fits every person or even all of that particular commodity that a person has. It is tools that you need to understand, just like the tools you got in your toolbox in your shop. You got to know how all of them work, or else you're not going to be able to fix things as efficiently as you'd like to. You need to assess your risk tolerance. How deep are your pockets? And that often involves multiple people that you want to talk with. Your accountant, certainly your banker, certainly your spouse or significant other. Okay? All of those things involve how much risk can we take, and how much, if we can't take a lot of risk, how much should we be offsetting? Certainly your financial tolerance matters. Do I have savings that can get me through a bad marketing year? Do I have excess borrowing capacity? Those sorts of financial issues. Lender-borrower communications is absolutely critical. If you're going to short hedge and if you're going to need to borrow money for margin calls, make sure that lender understands your marketing strategy, what that margin money means, and the worst thing that can happen is to get involved, not have enough margin money to put into that account, get shut out of the market, and then have the market turn on you, and you lose two different directions. So that's happened to a lot of people. Your lender, if you're going to be using dollars from that lender, has to understand these marketing positions. And finally, as I mentioned before, understanding a whole variety of approaches is really, really critical. I'm going to leave you with a picture of my brother's corn out near Laurel. That averaged about 200 bushel an acre the year I took this irrigated corn crop picture. It's very interesting in that when I asked him, should we be using futures or a forward contract on this corn, he very often says, no, I don't think so. He said, and I said, well, gee, you know why? He goes, well, I'm already forward contracting my malting barley. I already know where my production and price looks like for my sugar beets. I pretty much know my hay market. I don't have too much risk there. I'm going to take a flyer on something. Absolutely reasonable. Thinking about a portfolio, in his case, based upon his age, his financial situation, based upon how he's marketing his other crops as well. So with that, I'll leave you with that example, and certainly appreciate your tolerance and your time. Hopefully, at least on some of these in-person presentations that George is doing, I'll be able to answer some questions by phone with you. Thank you so much.